Hey there, it's Linda Hayes again. In this video, we're going to cover revenue recognition. So this is IFRS 15. First, I'd like to talk about some revenue recognition principles. And again, these are the new ones under IFRS 15. And it's what's called a contract-based approach. And a contract is what's outlining the seller's performance obligations, basically in return for consideration received from the buyer. And it's based on the enforceable rights and obligations in a contract. And those don't have to be in writing. They can be in verbal form as well. So revenue will be recognized at the time there's a transfer of the promised goods and services to the buyer. And the amount of the revenue depends on the expected amount of the consideration. Now I want to go through some of the journal entries for revenue recognition under this new contract-based approach. Now, a lot of times when you sell goods to a customer, you're going to debit accounts receivable, but you're going to see in the first box here, it says performance is complete, but it's a conditional right to consideration. In other words, they're not obligated to pay you just yet, but you did transfer some goods or services, but the consideration is contingent on something happening. So it might be, for example, that you deliver another distinct performance obligation before any payment is required. So maybe it's a delivery of two different things. You deliver the first one, which means you've done something, but they don't have to pay you till you do the second one. So in that case, you can't be debiting accounts receivable because they don't owe you anything. So instead, you're debiting, in this first box, the contract asset. Now, many people will call that an accrued receivable because it's not in the AR module yet, but it can be an accrued receivable. And you credit revenue because you've done the work for that particular good you did deliver. And then when the conditions are met and the new unconditional right to consideration is met, that's when you're going to debit the accounts receivable or cash if they pay you cash right away, and of course credit that contract asset. Okay, so basically we're temporarily putting something into the contract asset, even though they don't really have to pay us just yet, but we've done some of the work. The second box in the middle there is when you receive consideration, but you haven't done the work yet. You haven't completed the performance. So you receive payment up front before you do your work. Well, in this case, we're going to debit accounts receivable, but we're going to credit contract liability. Now, under past GAAP or under ASPE, oftentimes we're going to call that unearned revenue. And even under IFRS, you don't have to call it contract liability, but you could. And you could also just call it unearned revenues. Then, once the performance is completed, the goods or services being transferred, basically, that's when you're going to debit that contract liability and credit your revenue. So when a customer pays you in advance, obviously, in the beginning, we don't have revenue until we meet the performance obligation. The third box there says performance is complete and there's an unconditional right to consideration. So at this point, goods and services are transferred and they owe you the money. Well, those are the simple ones. Debit accounts receivable, credit revenue. IFRS 15 has 5 steps for contract-based revenue recognition. So we're going to go through each of those. So step 1 is to identify the contract with the customer. Step 2, you identify the separate performance obligations. Sometimes there's only one thing you're doing, like you're giving a good to a customer. Other times you have multiple things. Step 3, determine the overall transaction price. And then once you know that, in step 4, you can allocate that price to the different performance obligations that you figured out in step 2. An example of that would be a cell phone contract. You might pay one price up front for both a cell phone and towards a plan, and those things, basically the amount, will have to be allocated to each thing you're doing. And under step 5, of course, is where you're going to recognize your revenue as you do the performance you're supposed to do. So the performance obligations being satisfied mean you can recognize revenue. So now let's go through some more detail on the 5 steps. So the first one is identifying the contract with the customer. And again, contracts can be written, they can be oral, or they can even be implied by common business practice, but they must be enforceable. What criteria need to be met? Well, first of all, commercial substance has to exist, and that means there's a business reason for each party to enter into the contract. Number 2, the buyer and seller have approved the contract and are committed to perform. The third thing is that rights regarding the transfer of goods and services can be identified. Payment terms have to also be specified, and collection of the consideration also has to be probable. Under the second step for identifying the separate performance obligations, you have to look at whether the contract involves separate and distinct goods and services. So what that means is that the customer can benefit from the good or service either on its own or with other readily available resources, and that the good or service is separately identifiable. So, for example, there may be a couple of different things that are being done for this particular customer, but at times they can't use one without the other. So for example, if you had very customized software where you had to sell the software to them and do all of the customization so that it interfaces with everything else, they can't really use the software unless you do that work. So those are not separate and distinct. So you have to do all of that work together. It would be one performance obligation. However, if you were just selling one piece of software where they could use that on its own without any updates or without any training, and you were having training or updates in the contract and you could get those elsewhere or you didn't need them, then there would be separate performance obligations. And why do separate performance obligations matter? Well, because as we said, you have to take your price in step 3 and allocate that to the different obligations getting into the revenue recognition. Now, another thing about determining the price, you might think, well, if the contract says it's $100,000, that's the price. But we have to consider other things like discounts, rebates, incentives, penalties, variable consideration, non-cash consideration, and if there's payments that are far in the future, you have to present value them. Now, these things need to be estimated because many times, if it's future payments, you know when the payments are needed, so that's simple. But things like discounts and rebates, those may be based on future volume. So you would have to look at what you think is going to be ordered by the customer to say, are they going to get the discount or the rebate or not in the future, and recognize revenue on that basis. So there's lots of estimating when it comes to step 3. Now, how do you do your estimates? Well, there's 2 different methods that can be used. Number 1 is the expected value method, and that's using a weighted probability of various outcomes or the most likely amount. And in the textbook, you'll find a lot more details on how all of these things work. I just wanted to give a summary for you today. So step 4 is to allocate the transaction price to the separate performance obligations that you've identified in step 2. And so what you're going to do is prorate the price based on the standalone value of each performance obligation. And there's different ways you could figure that out. And so the criteria for the standalone value is basically the price at which each item would be sold separately. Now, sometimes that's easy because you might sell product A, B, and C separately, but there's a bundle price where a customer gets a discount. So for example, maybe you go to a camera store and the camera costs one price, the camera bag is another one, an extra battery is another one, but if you buy all 3, you get a discount on the bundle. That's very common in many industries. And so if they sell each thing separately, very simple to allocate the price. However, sometimes one thing may not be sold separately at all. And in that case, you have to estimate the different components and what you should allocate. So you're going to do estimates either based on number 1, an adjusted market approach. So you use a competitor's price for a similar good or service, and then you adjust for any differences. Or number 2, you can use an expected cost plus a margin approach. And then if you have a standalone selling price that cannot be determined at all, then you might be able to use the residual approach where you know the price of one item and the difference must be for the other item. Moving now on to the final step, step 5, that's where you're determining when the performance obligation is complete, where revenue can be recognized. So for completion to occur, it's when control of the good or service is transferred to the customer. And what does control mean? Well, it's the ability to direct the use and obtain the benefits of the good or service. And it can be transferred either at a single point in time or over a period of time. And 3 separate criteria must be assessed to determine if control passes over time. And if the criteria are not met, the control is assumed to pass at a single point in time. And again, there are examples that you can go through that will help with this. So again, reading the textbook will give you a little more detail on this. So indications of transfer of control. Number 1, the seller has the right to payment. Number 2, legal title, physical possession, and or significant risks and rewards have transferred. And 3, the customer has accepted the item. Now I'd I'd like to talk about warranties and service agreements because they're pretty common in many industries. So the nature of the warranty impacts whether it's considered a separate performance obligation. And there's two approaches to accounting for a warranty or a service agreement. So if you analyze and you realize there's no separate performance obligation, you would do what's called a cost deferral. Whereas if there is a separate performance obligation, you're going to do a revenue deferral. And again, with the revenue deferral, it means you're going to not recognize all of the revenue. You're going to have some in a deferred account until that performance obligation is met. Now let's go through a little more detail on both methods. So again, if you have no separate performance obligation where you're doing the cost deferral, that's basically used when the warranty is provided just to give assurance that the product will meet the agreed upon specs and the warranty is not sold separately. So this is the case for lots of appliances. You go in and you say, I want this, and there's a 1-year warranty on it, right? And it's just saying that the product is going to work as it should. So there is no distinct service. So you're going to accrue the estimated costs of the vendor's remaining performance obligation as a provision, and then you'd expense it when the revenue is recognized. And any future costs would be charged to the warranty provision as they're incurred. And at each reporting period, you have to reflect your actual warranty cost experience. So basically, just to say that in a little more simpler term, is as you sell goods, you'd recognize the expected cost of what the warranty is and each period adjusted. Under the revenue deferral method, it's a bit more complex because here we say that there is a separate performance obligation. And in other words, the warranty is something that can be purchased separately, and it does provide the customer with future services in addition to just product assurance. So the warranty here is a separate performance obligation, and that means you have to allocate part of your total revenue to the obligation. The warranty then would be deferred as a contract liability and recognized over the life of the warranty. So then you would have your warranty or servicing costs charged to expense as incurred, and the proportion of revenue from new sales that is deferred would be adjusted periodically again to reflect your actual cost experience. And there would be no adjustment of deferred revenue already on the books other than through the passage of time. So again, if you had an extra, say it's a 2-year warranty, you're basically saying that I need to defer some of my price over that 2-year period. So I did say I wanted to go through some examples in this. So we're going to look at one where there's sales with a right of return, and it is predictable. So under the contract, this company delivers 200 units to customer A for $120 each on March 1st. Rigor's documented policy is to allow a customer to return any unused product within 60 days and receive a full refund. The cost of each product is $90. Based on historical experience, Rigor estimates that 3% of the units will be returned, and they do expect the returned products can be resold. So in other words, it's not that they think the products are going to be broken, it's just that the person did not like them, and so that's why they can resell them. Now I want to go through the specific journal entries. So here, because there's the right of return, we can't recognize all our revenue. So we are going to debit accounts receivable for the full amount, which is the 200 times the 120, which is 24,000. But we can't recognize 24,000 of revenue. What we're going to do instead is take our 24,000 times 0.97, because 3% is what we expect people to return. So we're crediting revenue for 23,280. So the other credit has to go to what's called refund liability. So that's $720. And what we're going to do as well, and this is one of the things that a lot of students miss on exams, is when you think you're going to get goods back from a customer and you're going to basically reduce the amount of revenue, you also, if you get goods back, will have to adjust your cost of goods sold. Because again, whenever you book revenue, you have a related cost of goods sold. And whenever you have a refund liability, you have a right to recovery asset in this case, because you're getting the product back from the customer. So what we're doing here is we're debiting cost of goods sold, and the inventory amount, we have to take it out at the full cost of the $90. So for the credit to inventory, it's 200 times 90, which is 18,000. But again, we have to times it by 0.97 to get our debit to cost of goods sold, which is 17,460. Well, where does the other debit go? It goes to the right to recovery asset. So this is the expected amount, $540, of what we expect to get back in inventory from the customers that return the good. So now I want to do an example from the step 4, which is the allocation of consideration. So suppose on December 20th that this Crease Computer Company entered into a $900,000 contract with a customer, and they're providing a mainframe computer plus 3 years of regular service. So the computer is sold separately for $800, and the 3-year service agreement is for $200. So you can see here 8 plus 2, that's $1 million. And the customer's getting a discount so that it's only $900. So when you're using the 5 steps, you can go through it and say, okay, well, I'm going to get to the allocation of consideration. I know there's 2 different performance obligations because that service agreement isn't just that it works in compliance with the specs. So what I'm going to have to do is allocate that basically the 8 and the 2, which is the million, to the 900,000 price. So when I'm looking at the sale of the computer, which is the performance obligation number 1, what I'm going to do is I'm going to say, okay, well, 800,000 is a standalone price divided by $1 million, and I'm going to times that by the $900,000 price. So that gives me $720,000 of revenue from the sale of the computer. For the revenue from the service contract, obviously it's the difference, but the way you calculate it is you take the 200 standalone price divided by the million times the 900 price, you get $180. Now obviously the 2 together better equal your total standalone, the total price in the contract I should say, which is 900,000. So because we're getting the 900,000 up front, we're going to debit cash 900. We're going to credit revenue from the sale of equipment for 720, and of course our contract liability account is where the rest goes, and that is the 3-year service contract. So that'll be the 180. And then each year, if we were looking at the journal entry, we're basically going to debit the contract liability, it's not on the slide here, and credit revenue for the service contract, and it would be 60,000 per year, because again 180 divided by 3, that would give you the 60,000 that you're going to recognize for that revenue each year. The final thing I want to cover under the revenue recognition is when you're transferring goods and services over time, because there's many different ways you can do that. So for long-term contracts, you would recognize revenue over the period of the contract. And the first type is where the customer receives and consumes the benefits as the contract progresses. And an example of that would be a cleaning services contract. So you're doing monthly work and you're going to recognize revenue as you do the work, so monthly, for example. The next type is where the contract creates or improves an asset controlled by the customer. Example, if you are building on a customer's land, the customer is basically getting their property improved over time. And we're not going to do accounting for long-term construction contracts in Accounting 3115 at MacEwan, but if you do need to do it, it's very detailed and you do recognize revenue as you do the work on the building. And so that's something if you need to do, you can look in the textbook, but for this particular course, we're not covering it. The next thing is where the contract creates an asset or a benefit to the customer with no alternative use to the seller, and the seller has the right to payment. In that case, the contract terms restrict the use, or it might be too specialized to be resold without substantial losses. So this is where you're building something that's basically based on the customer's unique specs, or it could be a consulting engagement. So if you're writing a report for a customer and it's only for their purposes, like an audit report, you're going to be recognizing revenue over time, not just at the end, because you can't sell that to anyone else. Whereas if you're manufacturing, a piece of equipment that you're selling to any customer, you're going to recognize revenue, of course, when that's sold to the ultimate customer. So that is everything I wanted to cover for the chapter on revenue recognition. And as always, make sure you do lots of practice so that you can solidify the concepts that we've covered.